Understanding fixed and variable expenses. Fixed expenses are costs that stay the same regardless of how much you sell in a month. A common example is your rent or payment on a building. No matter how much you sell, that figure stays the same. Another example is salaries. If you have someone who's paid by salary, their income stays the same no matter what that level of sales are for the month. As an FYI, though, it only applies to employees. Owners have what's called owner withdrawal. That comes way after you've paid everybody else. Other fixed expenses include insurance, utilities, interest, depreciation, and property taxes. All of these stay the same regardless of your sales. Variable expenses change based on your sales volume. Let's say we are making pins. The employees who manufacture the pins are paid a wage, and that wage is based on the number of hours they work. Those hours can vary depending upon how many pins we need to make. So their income would be a variable expense. We might hire salespeople to sell our pins. And in that case, we'd probably pay them a base salary, so that would be a fixed expense, plus commission. So the commission would be a variable expense. That would change based on the sales. Credit card fees is another example. As your credit card sales increase, the fees would increase. And things like shipping to get your product to market, that would be a variable expense. If an expense stays the same, it's called a fixed expense. If as your sales increase, your expense also increases, then that's a variable expense. Then you take your variable expenses and your fixed expenses, and altogether those equal your total expenses. And then as your variable expenses increase, your total expenses increase, but your fixed expenses stay the same. If you have questions, let me know.